It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make your contribution. Trust me, we are reliable, we will be there when you need us. Trust it, we are dependable, we will pay all your benefits due you. Trust it, we will always pay on time so you don't have to worry. Trust it, oh, trust it, trust it. SSNIT.
SNIT, we deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SNIT scheme. Trust SNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust me, we are reliable, we will be there when you need us. Trust it, we are dependable, we will pay all your benefits due you. Trust it, we will always pay on time so you don't have to worry. Trust it, oh, trust it, trust it. SSNIT.
SNIT, we deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SNIT scheme. Trust SNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make your contribution. Trust it, we are reliable, we will be there when you need us. Trust it, we are dependable, we will pay all your benefits due you. Trust it, we will always pay on time so you don't have to worry. Trust it, oh, trust it, trust it. SSNIT.
SNIT, we deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SNIT scheme. Trust SNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust it, we are reliable, we will be there when you need us. Trust it, we are dependable, we will pay all your benefits due you. Trust it, we will always pay on time so you don't have to worry. Trust it, oh, trust.
Hello, welcome to SSNIT Virtual Infozone. My name is Joseph Poku. Today we are going to look at a very important topic that is so dear to the hearts of pensioners and beneficiaries of deceased members, past, present. Before we do that, let's have a recap of last week's presentation. Last week, we saw how to update our records and check our statement of accounts. To do that, we said we need to provide supporting documents such as gazette or affidavit to change your name or add another name. You can also update your residential address, email address, and telephone number. You can update your list. You need to update your list of nominees at least once every 5 years, once you're a member. To update or change your nominees, you must visit the nearest SSNIT branch to do so. Nominees or dependents must strictly be family members. So this is what we learned last week. Now let's come to our topic, past credit. Before the inception of Act 766 in January 2010, SSNIT was operating under PNBT Law 347, where the employee contributes 5% of his basic salary and the employer adds 12.5%, giving a total of 17.5%. Under this law, the pensioner has the option to take 25% lump sum, which is the total pension that is due him by law. In that case, it was 12 years. He could take a quarter of it upfront before he even begins taking his pension. And this was coming from the contributions that was coming to SSNIT, which was 17%. And when SSNIT received this 17%, it remits 2.5% to the National Health Insurance Scheme on behalf of the contributors. And then the 15% was coming to SSNIT. So your contributions and your benefits dependent on the 15%, where you could take 25% lump sum upfront. Now, when the new law came into effect, that is at 766, the employer had to increase his contribution from 12.5% to 13%, and the employee contribution increased from 5 to 5.5%, giving a total of 18.5%. Now, out of this 18.5%, 5% of it goes to the second tier, and then 13.5% comes to SSNIT. The 13.5% coming to SSNIT again remits 2.5% of it to National Health Insurance Scheme and keeps the 11%, which is to take care of the first tier under 766. Now, because people qualified, they had the option to take 25% lump sum under the old law, and the new law doesn't provide or doesn't pay 25% lump sum or a lump sum to members. There was a calculation done by the actuaries in the trust, which indicated that for anybody who opted for 25% lump sum, the total lump sum paid to that person was equivalent to 4% of the total salary that the person got in his entire life. Meaning that the 25% lump sum was equivalent to 4% of the total salaries. So, because by law and by the age of the member, you were forced under the new law, and you had made contributions under the old law, there was a need to pay you the equivalent of the 25% lump sum that you'd have received if you are retired in December 2009. So that formed the legal basis for the computation of the tax credits. And this is spelled out in section 94(1)(d) of the National Pensions Act 2008, Act 766, which says that accrued or past service or past credits earned by every contributor to whom the new scheme applies in respect of the 25% lump sum benefits shall have the lump sum determined by a formula agreed between the NPRA, now, that used to be the National Pension Reform Implementing Committee, and the trust based on actuarial assessment. Now, so these past credits are essentially the entitlements accrued by individuals based on their past contribution to SSNIT scheme as of December 2009. So you can define the past credit as the equivalent of the 25% lump sum earned by all members of the PNBT Law 347 who qualified by age, that is those who are 50 years as of December 2009. That is after the amendments that are PNB Act 883, and they qualified because the law has made them, put them under the law, under the new scheme, and who were migrated from the old scheme to the new scheme, that is at 766, before 1st January 2010, which is calculated at 4% of the annual salaries from the date of first contribution up to December 2009, and compounded annually at 50% of the prevailing Government of Ghana 91-day eligibility rate up to December 2009. It sounds like a mouthful, but we are going to break it down. What it means is that anybody who belonged to the old scheme and the law had moved you to the new scheme, you were entitled, and you had made contributions under the old scheme before the law came into effect, you were entitled to a past credit. And that past credit, when the law says it should be determined to be done based on actuarial assessment, that is the agreement between SSNIT and NPRA. So the past credit was based on was focused on the following. First, there was an agreement, an MOU, that was agreed upon, and it was to calculate what percent of the contribution salary of those who qualified for past credits, and then the interest to be paid on was to start to be 50% of the prevailing TB rate as is applied under Section 34.1 of the PNDC Law 247. If 34.1 of PNDC Law 247 tells how we return contributions to members who do not qualify for pension under that law. So, before the inception of the Act 766, the formula used to return contributions to members was based on the 50% of the prevailing TB rates that we compound annually. So that was the formula. And so this was agreed and used to compute the past credits up to December 2009. Now, in an MOU signed by all parties, as the NPRA, SSNIT, and those stakeholders, the NPRA suggested that we use 75% of the prevailing TB rates as applicable interest for the accumulation of the determined past creditors at December 2009. SSNIT agreed to this MOU based on Section 72(1)(b) of the National Pensions Act of 2008, Act 766, which is almost like the PNDC Law 247, Section 32, which stipulates how contributions are returned with interest to beneficiaries. So that was used to pay the past credit. That is from January 2010 until the person retired in the future. Now, a ministerial committee was set up in September 2017 to discuss and make recommendations on the issue of this past credit, because there was some misunderstanding between the stakeholders. So Labour later argued that since the past credit so determined in December 2009, it's a lump sum for each member, with effect from January 2010, and not return of contributions, the interest rate of 75% that we had agreed to apply on the past credit was unacceptable to them, and that we should use the full TB rate, that is 100% TB rate, compounded quarterly. Now, after the ministerial committee had completed this work, a communique dated 24th November 2017 was issued and signed by all the relevant parties. So management of SSNIT, in consultation with the Board of Trustees of SSNIT, agreed to all the recommendations and has since implemented same. And to repeat, the recommendations are that the interest on the past credit from January 2010 to the person retired to be based on 100% treasury rate that is prevailing, compounded quarterly. So you see the pictures on your screen, which gives you the trajectory, how the interest rate that has been applied on the past credit has progressed. It started with 2% before 2010, January, and then from 2010, January to date, it was 75% prevailing rates that was applied. And then after the agreement in 2017, it came to 100% TB rate compounded quarterly. Now, so this is the picture that you see over there. So up to December 2009, the past credit is compounded, that's a contribution 4% compounded annually with 50% TB rate prevailing. And then from January 2010 to the time the person retires, it is 100% TB rate compounded quarterly. And I must stress that this is based on actuarial assessments as it is stipulated in the law. Now let me summarize what we've done so far. the past credit plus accrued interest rate from 1st January 2010 to date, or the day that the person retires, is what is paid to the member by SSNIT as a top-up to the Tier 2 lump sum. So because I said all contributions before January 2010, and that was made by the person who was moved into that 766, the person would have qualified for a lump sum, but that lump sum is no more paid under the Tier 1. So the equivalent of the 25% lump sum from the time the person started contributing up to December 2009 with interest is what is called the past credit. So that one is going to be added to the lump sum from the Tier 2, which is now replacing the lump sum under Tier 1. So we're going to add up to it and make it complete. So it is not to be compared with what the person receives under Tier 2. They are not the same. They just go to complement it. Now, the applicable interest rate from January 2010, as I said, is 100% of the 91-day Government of Ghana Treasury rate, compounded quarterly. The rest of the lump sum, as I said, is paid by the Tier 2 private fund managers. It's important to emphasize that SSNIT does not charge any fee. There is no administrative cost on the past credit. The processing, the payments, no fees are charged. It's important to know that. It's not the same as the fund managers charging a fee of up to 3% on the returns. Now, let's take an example. This is where we want to break the myth. Because questions have come, how do you calculate this past credit? How am I able to check that you've done this correctly? And all kinds of questions. We understand your concerns. So we are going to break it down. Take a simple example. Take your calculators, your phones and everything, and follow me as I take you through a very simple calculation of past credits. Let's assume that Mr. Hagan was paid his past credit and benefit. For that matter, he retired in June of 2020 this year. And for the sake of the computation, to make it so simple, we are using the simple data as you see on your screens. 2007, 2008, 2009. So we have the rates that is prevailing, 9.87% for 2007, 17.25% for 2008, and 25.44% for 2009. This is coming from the Bank of Ghana. Mr. Hagan made 12 months contributions for each of the years. And the salaries you see are the salaries he earned in those years. And when you take 4% of the salaries, for example, 2007 had 3,000. 4% of it is giving you 136. And 4,000, when you take 4%, give you 165,200. So these are the 4% contributions, annual contributions, that we are returning to Mr. Hagan with interest. And let's see how we calculate that. So observe the figures. We have 2007, 120, 2008, 160, 2009, 200. So 120, 160, 200. 120, 160, 200. Let's keep that in mind. Now, take note of these abbreviations. TBR means Treasury rate. TBR 2010 Q1 out you see on your screen, don't get confused. It is the first quarter Treasury rate for 2010. Mathematicians want to confuse people. This is the explanation. Let's see how we apply it. Now, let's take 2007 figure of 120. This is as at, we are calculating the past credit as at December 2009. So we take the 120. And before I go ahead, if you have money, 1,000 cedis, and you want to calculate the interest, let's say you invest 1,000 cedis at the beginning of the year, and they say they will give you 10% of the 1,000 cedis. If you want to find the amount that the 10% translates into, just 1,000 cedis times 1 plus the 10%. That's 1,000 cedis times 1.1. And that gives you 1,100. Which means your interest is 100 cedis. That's the same principle we are applying here. Number two, the contributions that came in 2007, they were all not received at one point. That is, they were not all received at the beginning of the year, or at the middle of the year, or at the end of the year. They came in monthly. As you all know, the employers pay their contributions monthly. So January contributions were received in January, assuming February in February, and so on and so forth to December. So we want to know how long the money has been with SSNIT that we need to add the interest on. Now, because January 1, the contribution, assuming was received at the end of January, it has 11 months to travel to the end of the year before we get into the next year. So if you are applying the interest rate, the period applicable is 11 months. February has 10 months. March has 9 months to end the year, and so on and so forth. November has 1 month to end the year, and December has nothing. So if you do that, and you look at the period, 1 month for January, 2 for February, and so on and so forth, by the time you get to November, it is 0. So 11, 10, 9, 8, 7, up to 1. When you add all these, you get 66. That is 1 plus 2 plus 3 up to plus 11. It gives you 66 months. You divide by 11, you get 6 months. It means it is in order to choose 6 months to assume that all the contributions that came in that particular year were received in June, at the end of June. It means you have half of the year for that money, whole amount of 120, to travel to. It is fair. Because what you do is month by month, it will come to almost close to the same figure. So, when it comes to the calculation, you see 120 cedis into bracket 1 plus the treasury rate for 2007 divided by 4. Now, the division 4, the 4 you see there, is 1 half of the TV rate, that is 2007 divided by 2, and then the principal I just explained to you, which is half of the period for 2007. So half and half will give you the quarter, as you see there. So the formula for the first year is 120 times 1 plus the rate divided by 4. Then we are at end of 2007 now. So we are going to 2008. Then again, you apply the 2008 rate because that one has, the amount is going to take the full rate. You don't divide by half. So it's just the half, the 50% of the treasury rate. That's why you see TBR 2008 divided by 2. The same with 2009. By the time you get to the end, you take the full rate, 2009. So with the figure we saw at the table, the earlier table, we have the rates quoted there. I just put in the rates. When you do the calculation, it comes to 120 times 1.02475 times 1.08625 times 1.1272. And when you sum it up, you get 150.56. That is the 2007 tax credits, 2007 contribution. After applying all the interest, it moved from 120 to 150.56. Now we are going to do the same thing for 2008 contribution. That's the 4%. This time it is 160. So go through the process. So the first one is for the year 2008. Same principle. All the monies were not received the same. So we assume they all received in June. And then you travel half the period and then half the rate. And so you get divided by 4. And then the 2009, you get the full rate. So divided by 2. Put in the figures, do the math, you come to 188.13 for 2008. Then finally, for 2009, 200. This time, the principle is the same. All the monies were not received at the same point. So we find the average, which is the June, and then the half rate, and it's 50%. So half, 1 divided by 4. And when you do the math, 200 times 1.0636, you get 212.72. So these are the years, individual years. Now when you put all these three together, it gives you 551.41. And that is the past credit as at December 2009. Now we need to apply the interest to this 551.41. So in the tabular form, this is how it looks like. The 2007 one is 150.56 as we got, and so on and so forth, and the total is 551.41. Now, how do we apply the interest? First, let's do the old formula, which is the 75% of the TV rate. And that is what you see over there. This time, the principle I explained to you about half the period does not apply, because we have the bulk amount as at December 2009. And we are going to increase it, or we are going to add the interest up to the time the person gets paid. Now you see the formula over there, 3-star TV rate divided by 4, that's the 3/4, that's the 75% in all cases. So from 2010, 2011, and so on, up to the K, where K is the year before the payment. That is the payment before the payment year. So let's see how it applies to our example. So we take the 551.41, So we apply the 75% for 2010 rate, and 2011, and so on up to 2020. So in this case, our K is 2020. So we apply all the rates there. And you see in the formula that is 1 plus 3 over 48 for January, because we are doing it month. So we take the annual and then we divide by 12. And so we have the 3/4 all right. But because we are dividing by 12, we have the 4 times the 12, which gives you the 48. And that's what you see there as 1 plus 3 star over 48 over 48 over 48. But we are doing it monthly this time, not annual this time. So that is the difference in the formula. And when you put it together, it gives you 2,059 pesos as of June 2020. Now, with a new formula, which says apply full TB rates on the past credit as of December 2009 and compound it quarterly. Compounding quarterly means that you are applying the quarter rates 4 times in a year. So every 3 months, compute it. So it gives a higher figure because you compute with interest and you compute interest on the interest again for the next second quarter, then interest on their interest, another interest, third, and so on before the year ends. So it gives you more money. And that is what you see right there. So the 55141 that we saw at the end of December 2009 is now going to be calculated under the new formula. And that's what you see. So we take the quarterly rates and put in the formula just like before. But this time, it is done 4 times in a year. And the year ends, we enter in a new year, the new rates will apply like that. That's even simpler than the previous one. So when you do that, we arrive at 3,400 cities instead of 2,059. So you strike the difference, and it gives you 1,341 cities, 47%, as the difference between the past credits based on the old formula and the new formula. And this is as of June 2020. So the person is, Mr. Hagan is going to be paid in August, end of August, let's say September. So it means we calculated the interest as of June, but July has passed, August too has passed. So we need to add interest on the difference. And it's 2% per annum interest that we add on the difference. So we take the difference of 1,341, and then we add the 2%. You see the 0.02, that's the 2%. And because it's 2 months, you see times 2. And we divide by 12 because it's 2% per annum, so that we get a monthly rate. And when you do that, you arrive at 47%. That is the interest that will be added to the difference, 2 months interest. And so when you add that, you get 1,345.94 as the amount due to Mr. George Hagan as at the end of August 2020. This is how the past credit is computed. Now, this is the summary of it. So the person contributed for 36 months. The amount to be paid, was 3,400, and then the amount paid earlier was 2,059. You strike the difference, it gives you 1,341. The interest on it is 4.47, and then the amount to be refunded becomes the interest plus the difference, which is 1,345.94 as of August 2020. Now, let me say that we have pulled data and computed past credits and paid them in batches as we speak. This is because we are using a different system because of the urgency of it. We use a different system to pay the past credit. And that is different from the past credit you see on your statement or on your advice if you go for your advice. So we have already printed the past credit statement for beneficiaries who qualify to know how much they are supposed to get at every point in time. Now, branches have been advised to explain to beneficiaries who come to them that the past credit amount they see on the payment advice is based on the old formula, and the past credit they see on the statement, it comes under the bottom of that past credit statement, is based on the new formula at the time. So the difference we pay to them in due course. As I speak, the first batch we paid about 20,000 beneficiaries, amounting to about 59.6 million, in excess of that. And then the second batch which involved about 2,253 people, also had about 7.8 million cities paid. So, we paid well over 68, almost 68 million, or 68 plus million cities for the first two batches. The third batch is yet to be paid to members. And anytime soon, you'll have them in the account for the pensions. Let me spend a minute and talk about the survivors' beneficiaries. With the survivors' lump sum, deceased members who qualify for past credits are going to be paid, the survivors are going to be paid the difference. But in this case, you need to walk into our office and apply for you to be identified as a beneficiary, somebody who has been paid a past credit before, and so, or a benefit before, so you qualify for past credit, and we process and pay the individuals. So that is why we are saying the payment is ongoing. So you need to go there and apply for the benefits. Even your dad or whoever your relative that died and you benefited, and that person also was under 766 and made contributions under the old law, you qualify for extra amounts based on the new formula, which is the 100% compounded quarter and paid to members. So let us go through what we've studied this afternoon. A summary of it. The formula for the past credit was agreed between the Pensions Reform Implementation Committee, now called the MPRA, and SSNIT, or the Trust, based on actuarial assessments, and this is stipulated in the law. The past credit is 4% of the salaries accumulated with interest from the date the contributions were received, compounded annually up to December 2009 with 50% of the prevailing treasury rate. It is the interest, past credit, the new formula, plus accrued interest is compounded quarterly from January 2010, and it is displayed on the statement of account for members. SSNIT does not charge any administrative cost on the processing and the payment of the past credit. Thank you very much. At this stage, we pause to answer some of your questions.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust SSNIT, we are reliable, we will be there when you need us. Trust SSNIT, we are dependable, we will pay all your benefits to you. Trust SSNIT, we will always pay on time so you don't have to worry. Trust SSNIT, oh, trust SSNIT, trust SSNIT. SSNIT.
SSNIT. We deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust SSNIT, we are reliable, we will be there when you need us. Trust SSNIT, we are dependable, we will pay all your benefits to you. Trust SSNIT, we will always pay on time so you don't have to worry. Trust SSNIT, oh, trust SSNIT, trust SSNIT. SSNIT.
SSNIT. We deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust me, we are reliable, we will be there when you need us. Trust me, we are dependable, we will pay all your benefits due you. Trust me, we will always pay on time so you don't have to worry. Trust me, oh, trust me, trust me. SSNIT.
SSNIT. We deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust me, we are reliable, we will be there when you need us. Trust me, we are dependable, we will pay all your benefits due you. Trust me, we will always pay on time so you don't have to worry. Trust me, oh, trust me, trust me. SSNIT.
SSNIT. We deliver on our promise.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT. Do you want to enjoy a good life when you reach your... Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there, to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't...
So the first question is coming from Sylvester Kadi. It says, do I get the understanding that any SSNIT contributor prior to December 2019 belong to the old scheme is entitled to 25% lump sum, to December 2009? No. The new scheme, whoever belongs to the new scheme is by age. It says that if you were born after 1st January 1960, you belong to the new scheme. You don't have any choice. But if you were born before 1st January 1960, you belong to the old scheme, but you have a choice to opt for the new scheme. There are some people who opt for the new scheme because they couldn't make the minimum number of months to make them qualify for pension under the old scheme. So yes, it depends on the age of the person. That is what is going to determine the kind of scheme he or she belongs. So if you retired in 2009, it depends on your age. And obviously somebody retiring before 2009 will belong to the old scheme. That is because of the date in question, because it's from 2010 that the new law came into being. Janshra Emmanuel says, please, how do I calculate to get the exact amount to deduct for SSNIT from my payslip? I can only calculate the tier 2 to get it correct from my payslip. So on your payslip, in most payslips, you state the basic salary. SSNIT contributions are based on the basic salary, not on any allowances that will show on your payslip. So where your employer says your basic salary is 1,000, you find 5.5%, and that should be the SSNIT contribution from your salary. That should be deducted, and the employer will add 30% to that. So based on the 30, so in this case, it will be 8.5%. That is 185 cents out of the 1,000 cents. And your part will be 50 cents. The employer will add 135 cents. Emmanuel says, is your interest rate compound interest or quarterly basis or simple interest on the yearly basis? The interest rate for the new law, under the new law or the new formula, is TB rate compounded quarterly, 100% TB rate compounded quarterly. And it is compound interest. That's why you say compounded quarterly. It's a compound interest. We compute interest on interest every quarter as we move the year. And then Bobo is saying that I don't know how to calculate my online. Can you please help me, or can I come to your office? Yes, you can always come to our office and seek clarification. But the online one, you have a website. Our website, you go to our website, it will give you the direction how to estimate your pension, given the parameters that you have to provide. So these are the questions that people ask. And if you have further questions, please don't hesitate to visit any of our offices or branches, and we'll be more than glad to assist you.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you. It doesn't matter where you're from, make a move, make a contribution. Trust me.
Okay, so let's take the top tips for today. All contributors who start work before 3rd January 2010 and had contributions paid for them qualify for past credit. The past credit is 4% of salaries accumulated with interest from the date on which the contributions were received by the trust up to December 2009. Past credit plus accrued interest from 3rd January 2010 to date of retirement is what is paid to the member by SSNIT as a top-up to the Tier 2 lump sum. Past credit plus accrued interest every quarter is stated at the bottom of the statement of accounts for members who qualify. So these are the tips that we should take on. Now, our next week's presentation, join us the same time next week, and you may contact us on 0302-611-622 or WhatsApp line 050-0003-050. You can also follow us on social media at SSNIT Ghana on Facebook, Twitter, Instagram, and YouTube. Thank you so much for your attention, and see you next week.
Do you want to enjoy a good life when you reach your retirement? There's a place I know will see you through, but you have to pay a contribution to the SSNIT scheme. Trust SSNIT to always be there to put a smile on your face. When all is said and done, that's the time for you to live your best life. It doesn't matter who you are or what you do, there's a plan for you.